Hey guys, Scott here, founder Crown Money in the March Financial Insights update. So first things first, we are in a very, very rapid period of change globally. Heaps of stuff going on overseas, a few missiles floating around. But what we want to sort of really look at today is how is this going to affect Australia and obviously our future assets and everything else that we're looking to accumulate between now and retirement. So first things first, I'm not too sure if you guys have heard, but the CEO of Uber globally just came out and said that out of the 9.4 million employees that Uber has, that there won't be any of those 9.4 million with a job over the next 5 years, which pretty crazy to think about. So what that means is obviously rising unemployment, and that's just Uber. You may have heard of Afterpay. They just cut 40% of their workforce. So there's a lot of white collar as well as software companies where those jobs are just basically going to AI. And so what we sort of see on the horizon is a rising unemployment level. What that rising unemployment level does is 40% of Australians don't have $1,000 saved. So most Australians aren't like you. They aren't building buffers, safety nets and emergency funds, which you're well accustomed to. They are spending what they're earning. And as a result of that, if and when an emergency comes, like a redundancy that they didn't expect, they don't have the safety net or the buffers to fall back on. And so when they don't have any savings, a lot of the time, like, well, all my money is tied up in my house in equity. I need to sell my house to be able to tap into that money so I can actually feed my family, find a place to rent, etc., etc. And so what that means is greater supply of properties being put on the market and less demand because there's more unemployed people. There's not as many people buying. So we see property prices coming off over the next 3 years. And so not anything drastic, but like 10 to 20% would probably be the medium around Australia. Obviously, every different part of Australia is going to be sort of unique in its own sort of way. But we're seeing property prices coming down due to higher unemployment. People don't have the ability to pay mortgages. Huge amount of redundancies over the coming years for white collar workers predominantly being replaced by AI. And so you've got Afterpay dropping 40% of their employees. Uber saying we're not going to have 9 million employees over the next sort of 5 years. So a lot of this is sort of starting to take hold now. It's very early, but we just see over the time, like all property cycles, there's usually 3 years properties going up, goes sideways for 5 years, and it's going to go down for 2 years. And so we see that down for 2 years coming up and beginning in the next few years, 2027, 2028, etc. So what does that mean for you? I think it's really important to be continuing to build your buffers. I don't think it's a great idea to go into debt further and be buying assets with the speculation that it's going to be going up over the next few years. It probably won't. And so just keep your powder dry, keep your buffers high, build that sort of safety net so that if and when prices do come off, you're in a really strong position to buy at something where you're not having to sort of basically have a larger debt amount when you've got so much uncertainty with the economy and where things are in the world. So super shares, also the same, those share prices are probably going to come off over the next few years. So everything's sort of looking a little bleak, a little choppy. It's certainly not forever. Like all things, this is just a season. We've had an amazing summer. And so now we're preparing for winter, building our buffers and making sure that we're financially stable. So if and when an emergency comes, we're not panicking like the rest of Australia is going to. We remember during COVID, so many people calling us up, oh my God, I've lost my job. Everyone at work is freaking out. And we're like, man, you got $74,000 in savings, buffer, redraw, safety net, whatever you want to call that. You could fund your family's living expenses and your loan repayments for the next 9 months and not have to worry about work at all. Really? Yeah, really. And so that's what we're all about, is trying to get you into the strongest position possible to weather any storm that may be on the horizon. So you're financially stable and then eventually financially free. But where we sit at the moment is, I see a little bit of choppiness over the next few years. So bat down the hatches now, start preparing now to be in a really strong position. So nothing is going to unfortunately rock your boat like many Australians that are just sort of going into this blindly. And I think when they don't have any savings, it's going to hurt a little bit there. So that's what we see on the economic rates will probably go up another 1 or 2 times. With obviously everything happening over there in the Middle East, your cost of petrol, etc., should be increasing. So I sort of think that that increase in costs there could be inflationary, and then hopefully one more rate rise should be enough, and then from there they should start to stabilize. But as we know, rates don't move the needle. It's not what this is about. The shortest loan term is the cheapest loan. You are on the shortest loan term compared to a standard 30-year mortgage where everyone's refinancing for cheaper rates every 3 years, resetting their loan term, going back to the start of a 30-kilometer marathon. It's crazy, and that's why it's like half of Australians are retiring with a mortgage, is because they don't actually have the ability to pay that mortgage down because they keep refinancing every 3 years, and they're at the start of that 30-year loan. It doesn't move. And so this is the game, you know. Banks want you in debt for as long as possible. The more interest you pay, the more profit they make, the happier their shareholders. So everybody wants you in debt except for you and us. And so we're there to try and help you get out of it as fast as we can, guide you every step of the way. And so from that perspective, it's really just focus between now and for the next year or so to really call things tight. Don't entertain going further into debt just yet. It obviously it will pass, but why would you want to be going further into debt now when in a few years' time you may possibly be able to pick up that same asset for a little bit cheaper than what it is today? So that's everything that we are talking about in terms of where you're at. If you want any guidance or on your specific situation or any coaching, please let us know. We'd love to run a coaching session for you and just tell you what we would do if we were you in your position and why. In terms of our club champion, Alicia and Dougie, I mean, these guys are steaming ahead financially. They've paid over $65,000 off their principal in just 12 months. I think their savings rate was like 27%, which the average savings rate in Australia is 5%. So that's literally 5 times more than the average Australian saving. So doing a phenomenal job, paying that much off the mortgage in 1 year and saving 27% of their income is insane. So congratulations, guys. Couldn't be more proud of you and looking forward to seeing you continue on that hot streak there. But if anyone is sort of just wondering how well you're doing, the average Australian does $10,000 per year in debt reduction. What does that mean? Every single month when you get your statements, the average Australian would get a statement saying you paid $800 off your mortgage this month. So as long as you're doing more than $800 per month off your principal reduction every month, you are ahead of the masses. You are ahead of the average bear where they're doing 10 grand. Our average client's doing 30 grand. So our average client pays it off in 12 years compared to 30. This is the smartest way to manage your money. You've got a structure, you've got a system, you've got accountability, you've got tracking, you've got measuring. Those are the secret ingredients to help you pay your house off, which is why every 28 days we're lucky enough to call one of you guys and say, congratulations, you are free from mortgage prison. So hold the course. As I said, just call it tight for the next few years and see how things unfold. It's something where I'm hoping I'm wrong, but just all the early signs are starting to show there are a few cracks appearing. So look forward to having a chat next month. Any other questions, reach out to us and the team. Always happy to help wherever we can.